Good morning, Mr. Aldrin Nico Aguilar. We are the Group 7, and we are about to present to you our report about introducing financial management together with my group mates, Mr. Janelle Hidalgo, Ms. Rose Evera, Ms. Cristina Cassandra Dizon, Ms. Rosario Pamintuan, Ms. Kimberly Rhea Ramos, and lastly myself, Ms. Krisha Baile. What is finance? Finance is defined as the management of money and includes activities such as investing, borrowing, lending, budgeting, saving, and forecasting. The finance field includes three main subcategories: personal finance, corporate finance, and public government finance. Finance is also the art and science of managing money or management of money. To further understand what is finance is, the next presenter will explain further information about why do we need to study finance and the different issues of finance.
Why study finance? The study of how to raise money and invest it properly and productively, since individual, businesses, and the government entities all need funding to operate the finance field, including the four main subcategories, which is marketing, accounting, management, and personal finance.
Key issues in finance. Challenges and issues in finance are common thing. Current issues includes economic and regulatory of the financial crisis and the growth of new types of finances. However, key issues are first, where to raise financial resources from, second, where in to invest the resources, third, how best to manage the production distribution functions, and lastly, how much of profit to distribute and how much to retain. These issues should be handled wisely or otherwise allocated finance will pluck out.
Finance. We have three categories of finance. First, we have financial management, next is capital markets, and last is investments. Financial management. It is the application of general principles of management to the financial possessions of an enterprise. Goals of financial management. A goal of financial management can be to maximize shareholder wealth by paying dividends and or causing the market value to increase. Capital market. The part of a financial system concerned with raising capital by dealing in shares, bonds, and other long-term investments.
Investments. Investment is the dedication of an asset to attain an increase in value over a period of time. There are three categories of investments, which is security analysis, portfolio theory, and market analysis.
Two pillars of finance are risk and return. Let's define risk and return separately. Risk is the probability that an investment's actual return will be different from the expected return. Risk can be low, in other words, the chance that an investor will lose some of his investment, or risk can be high, in other words, the chance that an investor will lose most or all of his investments. Return is simply the profit on an investment. It can be measured in absolute terms or in percentage terms. High risk equals high potential returns, and low risk equals low potential returns. An important thing to remember is that high risk means a higher potential return. It does not guarantee high return in general. Whenever there is a risk or the chance of return and an equal chance of loss. Suppose you could invest in a stock that will do one or two things. It will either return 10% on your investment or become valueless, resulting in a total loss of your money.
Finance function. The finance function is a part of financial management. Financial management is the activity concerned with the control and planning of financial resources. In business, the finance function involves the acquiring and utilization of funds necessary for efficient operations. Finance is the lifeblood of business. Without it, things would not run smoothly. It is the source to run any organization. It provides the money, and it requires the money.
Financial decision of the firm. We have four decisions. The four decisions are investment decision, financial management decision, dividend decision, and working capital decision. Investment decision. This decision relates to the careful selection of assets in which funds will be invested by the firms. Financial management decision. The decisions that have to be taken with respect to the capital structure are known as financing decision or financial management decision. Dividend decision. It is related to the distribution of profits earned by the organization. And lastly, working capital decision. Working capital is the amount of capital which is readily available to an organization. Under the working capital decision, we have two key decision points: the level of investment in current asset and financing of current asset.
Key issues in financial decision making. Decision making helps to utilize the available resources for achieving the objectives of the organization unless minimum financial performance levels are achieved. The key issues includes investment decisions, financing decisions, dividend decisions, and working capital decisions.
Organization of finance function. Here are the finance within an organization, the board of directors. First one is the CEO or Chief Executive Officer. Next is COO or Chief Operating Officer. And lastly, the CFO or Chief Financial Officer. Financial Manager role. Financial activities of a firm is one of the most important and complex activities of a firm. Therefore, in order to take care of these activities, a financial manager performs all the requisite financial activities. Here are the main functions of financial manager: raising of funds, profit planning, allocation of funds, facilitate pricing of product, managing asset, forecasting of cash flow, and may more.
Forms of business organization: sole proprietorship, partnership, corporation. First is sole proprietorship, the simplest and most common form of business ownership. These businesses are owned by one person, usually the individual who has day-to-day responsibility for running the business. Sole proprietors can be independent contractors, freelancers, or home-based businesses. Sole proprietorship advantages: easy to start, least regulated, single owner keeps all the profits, tax once as personal income. Disadvantages: limited to life of owner, equity capital limited to owner's personal wealth, unlimited liability, difficult to sell, ownership interest. Next is partnership, two or more owners. These come in two types: general and limited. General partnership: each partner is fully responsible for liabilities. In other words, even if you invest a little into a general partnership, you are still potentially responsible for all of its debt. Limited partnerships allow one or more partners limited liability based on amount of capital invested. Must have one general partner with unlimited liability. Names of limited partners may not appear in the name of firm. Limited partners may not participate in management decisions. Partnership advantages: two or more owners, more capital available, relatively easy to start, income tax once as personal income. Disadvantages: unlimited liability, general partnership, limited partnership. Partnership dissolves when one partner dies or wishes to sell. Difficult to transfer ownership. And lastly, corporation. A corporation is considered by law to be a unique entity, separate from those who owned it. A corporation can be taxed, sued, and enter into contractual agreements. The corporation has a life of its own and does not dissolve when ownership changes. Corporation advantages: limited liability, unlimited life, separation of ownership and management. Transfer of ownership is easy, easier to raise capital. Disadvantages: separation of ownership and management. Taxation of company profits can be an issue. These are three types of corporations: C corporation, S corporation, and limited liability company. C corporation. A C corporation is a corporation that is taxed separately from its owners. It gives the owners limited liability, encouraging more risk-taking and potential investment. S corporation. An S corporation, also known as subchapter, S corporation offers limited liability to the owners. S corporations do not pay income taxes, rather, the earnings and profit are treated as distributions. The shareholders must report their income on their individual income tax returns. Limited Liability Company. A limited liability company, or LLC, is a hybrid business structure that provides the limited legal liability of a corporation and the operational flexibility of a partnership or sole proprietorship. However, the information is more complex and formal than that of a general partnership.